You've heard of Peter Lynch, the investor who turned $18 million into $14 billion at Fidelity Magellan, averaging nearly 30% returns a year. When Lynch talks, investors listen. He's thrived through booms and busts, and his advice is more relevant than ever in today's wild markets. Today we'll break down Lynch's core principles for not just surviving, but thriving during market crashes. Forget market timing or panicking over red numbers. We'll show you the mindset and strategies Lynch used to turn fear into opportunity. By the end, you'll have a clear playbook for handling downturns and building long-term wealth, even when it feels like the sky is falling. Let's dive in. Peter Lynch, a legendary investor, always emphasized a core principle. His first rule is deceptively simple, yet profoundly important for anyone venturing into the stock market. It's a guiding light in the often turbulent world of finance. Don't buy what you don't understand. This isn't just a suggestion, it's a fundamental rule for protecting your investments. Too many people chase hot tips and the latest buzz without truly knowing what the company actually does or how it generates revenue. They're essentially throwing money at something they don't comprehend. Lynch once bought Kaiser Industries, only to realize he couldn't clearly explain its core business model, even to himself. That realization scared him because if the stock tanked unexpectedly, he'd have absolutely no conviction to hold on, no rational basis to believe in its long-term potential. If you don't understand a business and its underlying fundamentals, you'll inevitably panic and sell at precisely the worst possible time, locking in your losses. Imagine owning a local coffee shop. You'd immediately understand if a bad month was simply due to unusually bad weather, and certainly not a valid reason to sell your entire business. You need to cultivate that same level of understanding and confidence when investing in stocks. Before you buy any stock, always do your homework diligently. Carefully read the company's annual report, thoroughly understand the products or services they offer, who their primary customers are, and the nature of their competition. If you can't clearly and concisely explain why you own a particular stock to a fifth grader, then you're not truly investing, you're simply speculating and gambling with your hard-earned money, and speculating wildly during a market crash or period of high volatility is a guaranteed fast track to significant and potentially devastating financial losses. Stick to investing within your own circle of competence in industries and businesses you genuinely understand. Build a diversified portfolio of companies you deeply understand and can confidently hold through any economic storm or market downturn. That's the key to not only surviving market volatility, but also thriving in the long run. Lynch's next lesson, a crucial one for any investor to internalize, revolves around the inherent nature of market fluctuations. Market declines aren't some sort of black swan event, something incredibly rare. They're inevitable. They are a built-in feature of the market, not a bug. Corrections, defined as drops of 10–20%, happen almost every year. It's a regular rhythm of the market, a chance for it to reset and breathe. Bear markets, drops of 20% or more, are also a regular feature, not a disaster. They might feel scary, but they are a normal part of the economic cycle. If you can't stomach, both emotionally and financially, a 25% drop, then you probably shouldn't be heavily invested in stocks. Volatility, those ups and downs, that constant movement, is simply the price you pay for long-term growth and the potential for substantial returns. Instead of fearing these inevitable downturns, learn to see them as opportunities to strengthen your portfolio and secure your financial future. When great companies, the ones you've researched and believe in, suddenly go on sale, that's your chance to buy them at a discount. Always remember this fundamental truth. Every crash, every significant downturn, is inevitably followed by a period of recovery, and eventually, the market will not only recover, but it will also reach new all-time highs, surpassing previous peaks. If you've diligently done your homework, thoroughly researched, and own businesses you genuinely believe in for the long haul, then a market decline isn't a cause for panic or a reason to sell. It's actually a golden chance to buy more shares at a reduced price. So, the next time those alarming headlines scream market crash, and fear starts to creep in, just take a deep breath, center yourself, and remember the long-term perspective. This is normal market behavior. It's part of the cycle. This is your opportunity to capitalize on the market's temporary weakness and position yourself for future gains. Understand it, embrace it, and use it to your advantage. Peter Lynch, a legendary investor, didn't just tolerate volatility, he saw it as an essential part of the market and embraced it wholeheartedly. He understood that market swings, while unsettling to some, could present unique opportunities. Volatility isn't risk in and of itself, it's actually an opportunity, a chance to capitalize on market mispricing and temporary dips. This is true as long as the underlying business is fundamentally sound and robust. A strong business can weather market storms. Consider the case of Taco Bell. Its stock once experienced a dramatic crash, plummeting from $14 all the way down to just $1. Despite the stock's poor performance, the restaurants were consistently packed with customers, and the business was booming, showing no signs of slowing down. While others panicked and sold off their shares, Lynch recognized the disconnect and bought more, taking advantage of the undervalued stock price. This contrarian move proved incredibly successful, and Taco Bell eventually became a huge winner in his portfolio. So, what's the key takeaway here? Ignore the short-term stock price roller coaster. Instead, focus your attention and analysis on the underlying strength and prospects of the business itself. When a stock price drops significantly, the crucial question to ask is, has the fundamental nature of the business changed for the worse? If the answer is no, and the business remains strong, then the lower stock price represents a valuable gift, a chance to buy a quality asset at a discount. Volatility, therefore, creates excellent entry points for patient and discerning investors who are willing to look beyond the immediate market noise. The widespread fear and panic of other investors can often translate directly into your own unique investment opportunity. So don't run away from volatility. Learn to understand it, embrace it, and use it strategically to your advantage. That's precisely how the truly great investors distinguish themselves from the often panicked crowd, by seeing opportunity where others see only risk. The key is to buy when others are gripped by fear, but only if your thorough analysis confirms that the underlying business fundamentals remain strong and intact. Don't buy a stock just because it's fallen. Lynch warns against bottom fishing. A cheap price doesn't make a bad company good. Use price drops as a signal to dig into the fundamentals. Check the balance sheet. Is there too much debt? Are sales and innovation strong? If the setback is temporary and the business is solid, the drop is an opportunity. But if the company is losing its edge, stay away. Separate the stock from the business. The stock price is just noise. The company's health is what matters. Buy great businesses on sale, not just any business that's down. That's how you build a resilient portfolio. Lynch's secret weapon? The math of investing is asymmetric. Your losses are capped at what you invest, but your gains are unlimited. One 10-bagger can erase a dozen losers. You don't need to be right all the time. Just let your winners run. Too many investors sell winners early and hold on to losers. Lynch called this pulling the flowers and watering the weeds. Cut your losers, add to your winners. If the fundamentals are improving, let the stock keep growing. Compounding works its magic over years, not days. Real wealth comes from holding a few great companies for the long haul. Don't settle for small, quick profits. Aim for life-changing returns. That's the power of asymmetric investing. In a crash, it's easy to think this time is different. But history shows the market always recovers and moves higher. Over the short term, the market is driven by emotion. Over the long term, it's driven by business growth. Corporate profits have grown for decades, powering the market upward. On average, the market doubles every 8-9 years, even through wars, crises, and recessions. If you'd invested before the 2008 crash or the dot-com bust, you'd have recovered and profited by simply holding on. You don't need to predict the bottom, just trust in long-term growth. Invest steadily, through good times and bad. Time is your greatest advantage. Don't let short-term fear rob you of long-term gains. Lynch's final lesson: your emotions are your biggest enemy. Panic, not market crashes, destroys wealth. On Black Monday, 1987, while others panicked, Lynch stayed calm. He knew his companies were still strong. Build a system that overrides your instincts. Own businesses you understand, accept declines, and focus on fundamentals. Make your plan when you're calm, and stick to it when things get rough. Often, the best move is to do nothing, or keep investing as usual. Discipline protects you from yourself. That's how you win in the long run. To sum up, Lynch's wisdom is simple. Understand your investments, expect downturns, and use them as opportunities. Have conviction, stick to your plan, and let time work for you. Don't get scared by headlines. Focus on the real businesses behind the stocks. Know your why, and you'll know what to do when markets fall. If you found this helpful, like, share, and subscribe for more investing insights. Thanks for watching. See you next time.